All right, I think we can start. يعطيكم العافية. Thank you everyone for waiting. We're about to start the third session. Abdelmalik, are you gonna start this off? All right, Mike, I think you should start this.
Okay, thank you very much, Al-Jahara. Good evening, everybody. Welcome to the start of session 3. Apologies for the small delay. Session 3, if you remember, we're doing 6 sessions, and session 3 brings part 1 to a close. So first 3 sessions form part 1. There's a certificate at the end of part 1, and then we're going to move on to part 2 a week today, so next Wednesday, when we're starting sessions 4, 5, and 6. So well done to those of you who've made it so far. Hopefully you will also join us all the way to the end of session 6. What you will find is our content on options will become gently but persistently more deeper and more complex as we get towards the end of session 6. And that's the whole point. We start easy, we finish hard. We hopefully take everyone with us on the way. So talking about becoming a little bit more complex, the subject of today is the pricing of options. So let me just share my my first slide with you, and we'll go through what today is all about. As per before, the format is the same. If you want to ask questions on the chat, if you're in the Zoom room, then please do that as we go through, and I'll try to answer those at an appropriate moment, or maybe at the end. If you're watching on Twitter or YouTube, there is an email address at the end of the materials that you can submit questions to. Any questions that get submitted there, we will also endeavour to answer either at the start of the next session, or if they're interesting enough, we might use those to form the basis of what becomes session 6, which session 6 is more about an interactive Q&A where I just give you examples of options trading. You get to ask me anything you want, and we'll try and answer everyone's questions at the end of session 6. Okay. So here we are, session 3 then, on our single stock options journey. This is the map of the first 3. So we're on the introduction to option pricing and risk. Option pricing as a subject can be relatively complicated. It can be quite mathematical. If you were to pick up a textbook on option pricing, you would find that it probably goes quite heavy on the mathematics from page 1 and then doesn't let up all the way through the book. I'm going to try to do this with no maths at all. When we come to session 6, we will revisit option pricing, and we will do a little bit of maths in session 6. But all you're going to see that's mathematical today is the famous formula that most people use to price options, which is called the Black-Scholes formula. So that's the only bit of maths that we'll see today. Session 5 will do a slightly deeper dive for anyone who is interested in that. Okay, so what are we going to learn about today? So the usual 3 learning points. We're going to think about what drives the price of an option, what might move that premium up or down on any given day or minute or second, how we measure the risk on our option position. And by risk, I mean, how do we develop parameters or metrics which will tell us how the options price will change as all of the price drivers themselves change. So for example, one of the obvious price drivers is the level of the stock. As the stock moves up and down, how does the premium of our call option or our put option change? And these risk parameters will tell us that. And that's all leading into the third point, which is, which is how we use these risk metrics to understand our P&L. How are we generating profit and losses on our trades? And also, if we wanted to, how we could hedge our option to reduce our overall risk. So they're the three things that we'll be covering on this session. Just before we do, as we've done in the previous two sessions, let's have a look at that question that I asked you towards the end of session 2. So session 2 was all about combining options together, creating combinations like spreads and ratio spreads and risk reversals. And then we looked at something called a straddle and a strangle. Here we were talking about combining a straddle with a strangle. And I asked you to have a think about what this combination might look like, what it might be called. In order to find out what it might be called, it's not something you can necessarily work out, but a quick bit of internet research probably would have got you the name of this. Its name is a butterfly. So whenever you trade straddles versus strangles, buying one and selling the other, you enter into what we call a butterfly position. Okay, let's have a look at the details of our butterfly. So we have sold 10 contracts of a 100 straddle. If I just go and find the 100 point in my strike chain here, I can see that there's a bid offer price for both puts and calls. One interesting thing is that the prices are the same, regardless of whether we're pricing puts or calls, and that's very common when we have an at-the-money option. Here, my stock price is 100, so the 100 call and the 100 put are at the money. Okay, so I want to sell these options. Now, as a price taker, when I go into the market, where I can sell, certainly where I can guarantee to sell, is where the market is willing to buy. So that's going to be on the bid price of these two options. So I'm going to receive 5.637 real per share on 100 shares, because that's the size of one contract, multiplied by the 10 contracts which I sell. Simultaneously, I'm going to buy 10 contracts of this strangle, the 90-110 strangle, which means that I'm going to be trading a 90 put, so a put with a strike of 90, and a 110 call, so a call option with a strike of 110. And the way that we trade strangles in the market is we do set both strikes out of the money. So a low strike put and a high strike call. So if I go down the call side of things and find the 110, you can see that I can buy that at the ask side of the market for a price of 2.63 per share. And then if we go and find the corresponding put option, you can see that I can go and buy the 90 put at a price of 2.134. So I'm going to receive 5.637 twice when I sell my straddle, and then I'm going to pay away 2.63 and 2.134. So the net premium I receive is the combination of all of those premiums per share multiplied by 100, because that's my contract size, multiplied by the 10 contracts I trade, and this gives me a cash price in real of 6,510 real. And I will receive that on day one because I am net selling options. I'm selling options with a higher premium than the ones that I'm buying. Okay. In order to understand what view we have, we need to think about what's the shape of the payoff we've generated. If I sell a straddle, then just moving up into the top right here, I generate this triangular position where I make money, I receive my premium if nothing happens, and then I generate a loss on both sides if either the call or the put option finish in the money. When I buy the strangle, what it does is it just gives me protection against the stock going below 90 or above 110. And I've bought these in the same size, so my 10 contracts of the 100 put will be cancelled out by the 10 contracts of the 90 put if the market moves down below 90. And likewise, my 10 contracts of the 100 call will be cancelled out by the 10 contracts of the 110 call if we go above 110. And so you'll find that my 0 P&L line will be somewhere through here. And so essentially what this trade is a bet that we have low volatility. So the market doesn't particularly move and we finish in that shaded triangle there. But to do that, I'm taking a view that I want my downside to be limited as well. If I just sold the straddle, I would receive more premium, but I would be exposed to large and on the high side, theoretically an unlimited downside if the stock was to go up to infinity. By buying the strangle, I'm spending some premium, but I'm giving myself some protection. I'm locking in a maximum loss. So what I said in terms of the market view was this would suit somebody who had a view that we were going to encounter a period of low volatility, so the market would be relatively calm, but they did want some protection just in case they were wrong, in case the market went too far against them, left or right. The maximum profit, well, on a strategy like this, where essentially I'm making the bet that the stock stays constant and I just receive the premium, the maximum profit will always be located at the point where the stock is exactly where it is today. So the perfect result for me is the stock stays constant at 100. All of these options finish either right at the money or out of the money, and I just walk away with that 6,510 real of profit. So you can see my maximum profit, if the stock finishes at 100, is the full net premium which I've received. And I thought it might be useful if we just plotted this on a graph just to show you graphically how this looks. And this is the on expiry payoff. So you can see my short straddle has generated my triangular position here, a big receipt of premium, but then a quick tendency to a negative payoff if the stock moves either one way or the other. So there's my maximum profit up there at 6,510. My maximum loss, when either we finish below 90 or we finish above 110, is going to be 3,490 real. That's the difference between the 10,000 real difference of being short a 100 put and then long a 90 put, or being short a 100 call and long a 110 call, minus the 6,510 premium that I've earned up front. My break-evens for this trade are going to be between 94.49 on the low side and 106.51 on the high side. So as long as we finish between those 2 points, I will make money. And the closer we finish to the center, the more I will make. Okay, so this is a way that a trader would bet on a stock staying within a range, but it's a slightly less aggressive bet, slightly less assertive bet than just selling the straddle outright. So traders will trade butterflies when they want to express this short vol view. Of course, if I want to express the opposite view, that the stock does move, then I just reverse this trade. I would buy the straddle, sell the strangle, and I'm going to reverse all the numbers on this screen. Okay, we're going to come back and revisit butterflies towards the end of session 4, because there is another trade that traders do with butterflies to express a view not necessarily on where the stock finishes on expiry, but to express a view about the mathematics of the way that we assume the stock price will move into the future. But I'm going to leave that for the slightly deeper session 4, and we won't trouble ourselves with that for session 3. Okay, so that's the exercise debriefed. You will get all these materials in due course, so you'll see that that debrief working. You're able to go through that in your own time if that's useful for you. So for now, we're going to start to introduce the main topic of today, which is to talk about what is it that moves an option premium up or down on any given day or minute or hour. And there are really 4 things, and they're all in front of you on the screen. So I call these the main price drivers for an options premium. So there's movements in the stock itself, which I think is a relatively obvious one. If I own a call option, I want the stock to go up. If I own a put option, I want the stock to go down. It makes sense that the value of my option is dependent upon the level of the stock. It also makes sense that it's dependent upon the strike. If I own a 90 call, that's more valuable than owning a 100 call because it gives me the right to buy the stock at a lower level. So intuitively, I think we can understand that the stock price and the strike price are important. The next two things are interesting, though. The volatility of the stock and the time that we give between now and expiry are very important parameters for driving the premium of our option. Just before we go and talk about volatility in particular, I thought we'd just do a quick sense check just to make sure that we're all on the same page here. So this is your turn to have a think for 30 seconds about how the movement of the stock might change prices of options. So my question is, if the stock price goes up, and let's assume that we're trading at the money puts or calls here, a stock's trading at 100 and we're trading the 100 call or the 100 put. I want you to tell me, if that stock price moves up, which of the following price change should we see? So which of those combinations should we see? So I'll just give you 30 seconds. As usual, if you want to put an answer on the Zoom chat, that's fine with me. If you just want to have an answer in your head, that's also fine. So I'll give you 30 seconds to yourself, and then I'll let you know what I think. We've got a question on the chat about the influence of a financing rate. So that this would be an interest rate. It does have a small effect, mathematically at least. The way that it would impact the way you value options depends upon how your premium itself is financed. So it becomes quite a complicated topic if you are in a world where there is no interest, or you are in a world where you're trading on margin, and therefore it becomes more a function of whether there is any carry calculation around your margin account. But certainly if you're paying premium upfront and it costs you something to provide that premium, then that cost also, yes, that should be worked into your overall value of the option. Okay, just going back to the question on the screen though, most of the answers that are coming on the Zoom chat look correct to me. So the correct answer here is A. Apologies, my pen just changed the screen instead of circling. Okay, the call prices should go up, the put prices should go down. And the intuition here is, if I own a 100 call and the stock goes from 100 up to 110, it now becomes more likely, more probable, that the option will finish in the money and generate a positive payoff for me. So this, if we finish at 110, this call is now worth plus 10. If we'd finished at 100, the call would have been worth 0. So the movement up in the stock, I think intuitively we understand why the calls become more valuable. If I own a 100 put, of course, I get the opposite effect. The movement up in the stock has now made it less probable that my put option will finish in the money. The stock's now got to do more work to come back down again to finish below that 100 strike. So yes, the value of the 100 call will go up and the value of the 100 put will go down. Good. So in terms of movements in the stock and movements in the strike, calls and puts will have opposite signs to their price change. One will go up, one will go down. We do have similar sign movement or same sign movements when we look at the impact of volatility and time to expiry. Then we see both calls and puts increase in value or decrease in value, but hopefully that will become more obvious when we get to that point. Okay, just to put some actual numbers on this, what we've got here is we've got a series of call prices and put prices. You can see there are for strikes of 100. When I created these prices, I made the stock trade at 100 itself. And you can see I've got a volatility number here, and I've got a time to expiry number here. So these are 3-month options or quarter of a year options. And I've set the volatility to be 20%. We're just going to take that volatility as a number for now. And then in the next session, we'll explain more about what that 20% actually means. If we look at the prices of the calls, you can see that as the stock goes up, the price of the calls go up. So a call that starts with a premium of 4 generates a higher and higher premium as the stock moves up. And if you look across to where the puts are, you can see that we get the downward movement in the price of the puts. Good. So a positive correlation with the stock for call options and negative correlation with the stock for put options. If we were to move the strike now instead, then we see the reverse sign coming through. So again, if we're starting with both options at a 100 strike, and then we start to raise the strike, then we see the call prices decrease. A 105 call is worth less than a 100 call, a 110 call is worth less than a 105 call, and so on. And the intuition is that the lower the strike, the better the buying opportunity. For me, I get to buy at a lower and lower price. And consequently, the price of the puts go up as we raise the strike, because I'm given the right now to sell at an ever-increasing strike price. Now, of course, when we trade an option, we fix the strike. So the strike can't change once we do our trade. But in terms of understanding when we're comparing various trades that we might want to do, obviously the strike we choose will have an effect on the price we pay. But it's important to know that once we trade, the strike is fixed, and it's movements in the other 3 price drivers that change the price from that point on. Okay, so that's the effect of the stock price and the strike price. We're now going to think about these other 2 effects, volatility and the time to expiry, and we'll realize that they both have a very similar, if not identical, effect on the value of an option. So again, just for 30 seconds for you to have a think about this, and this is not an A, B, C, or D question now, it's just a more of an open question. Can you have a think about why you think the volatility of the stock should have an effect on the price of an option? So I'll give you 30 seconds. Again, just form some words in your head, and then I'll go through my explanation of why this is the case. Okay, so we're getting some answers on the chat. Somebody said higher volatility gives more probability of the price to move. More volatility equals more profit from the option. We're expecting a price fluctuation. Yeah, it's really interesting, the effect of volatility, because what we're talking about here is not a change in the probability that a stock moves up or down. If I've got a low probability stock, it might look something like this. It's trading at 100 today, but let's say in 1 month, it can move to, I don't know, 102 or 98. That would be a low volatility. And by the way, in finance, we always shorten volatility to vol, V-O-L. So if you see me write vol, that's what I'm talking about. A high vol stock would look something like this. A movement of, a starting price of 100 today could become, I don't know, 115 or 85 over the same 1 month period. Now, the reason that an option will have a different value here is, of course, when I buy a call or a put, I only care about movements in one direction. Let's say I buy the 100 call, and I said to you, I'm going to give you a 100 call on the stock on the left-hand side here. What are you willing to pay for it? Now, if you look at the simplistic outcomes that I've drawn there, you could say, well, realistically, the highest the stock is going to is 102. And if it goes down, my call's out of the money and I won't exercise it. So I really don't care how far the stock goes down. All I care about is how far the stock goes up. And so you're going to be looking at the upside potential. Now, both of these may come with a 50% probability, but it's only this 102 that interests you because that's the move which generates a positive payoff. So in that case, if we get a move up in this low volatility stock, I'm going to get a payoff of +2 on my call option. If we now translate this across to the high volatility version, again, we're talking about possibly a 50-50 percentage movement up or down. But if we do move up, we move much further. And yes, if we move down, we move much further, but any result below 100 is mathematically irrelevant to me because I just walk away. So it's this asymmetry of the payoff, the fact that I make I get a positive gain in one direction, but I'm zero for all movements in the other direction, which give the option this sensitivity to volatility. So you can see if we finish at 115, my payoff is equal to +15. So higher volatility does not say anything about the probability of moving up or down. It just says if we do move up and down, we move further. And therefore, we give an option the ability to generate higher positive payoffs if it moves into the money. And like I say, if I own a 100 call, I really don't care if the stock finishes at 90 or 50 or 25 or 99.9 recurring. They all mean the same to me, which is 0. It's upside movements and the possibility of big upside movements, which is what I care about. Okay, so let's just go through a couple of things on the chat. If the volatility is low, does this mean the price is relatively stable? Yes, it does. The more volatile, the more expensive. Yep, that's true of an option, and that's what we'll see on the next slide. Volatility affects both the price and the size of an option position. It certainly affects the price. It might affect the way that you trade your size. You're always going to trade X contracts where X is 1 or higher. But if you're trading a stock which is very volatile and therefore options are quite expensive, you may choose to reduce the size of your option position. So you may trade 5 contracts instead of 10 contracts. If you pick a stock which is less volatile, you might have to do more contracts to give you the same profit opportunity. So yes, there possibly is a link between volatility and the position size that you actually trade. Somebody's asked, how does liquidity affect the volatility of a stock? It can have secondary effects. I mean, primarily what volatility does is just mean it can move up or down more. Now, what that can mean is that people trade it less. They are more wary of it. The risk-averse people may not like to trade a high volatility stock, and therefore its liquidity may suffer slightly. It may be less liquid than a more stable stock. So again, there might be secondary consequences that volatility can have on the liquidity of the position. So yeah, that's a good point. Thank you for those questions and those answers. Let's just tab forward now and have a look at the real prices here. So previously, remember, I priced this option with a volatility of 20%. And for now, we're just saying, okay, well, we'll accept that as a number, and then in session 4 we'll understand a little bit more about what this is. What you can see is, as I increase the volatility, the price of my 100 call increases, and so does the price of my 100 put. So this is the effect, and we'll see this with time to expiry as well, where both the price of calls and puts either both increase or both decrease as volatility goes up or down. So generally speaking, if we buy options in the market, we say we are long volatility because we want volatility to be high in a experienced sense. We want the volatility that we realize over time to be high, because then that will generate the biggest opportunity for a positive payoff. There is a mathematical definition of volatility, and we'll come on to that more next week in session 4, but it is a standard deviation term. For those of you who know a little bit about statistics, standard deviation drives how wide the distribution of future prices of this stock can be. So I say we'll do more on that in session 4. Okay, let's have a look at the time to expiry. Now, what you'll see is, as we give an option a bigger time to expiry, we also increase the price of both calls and puts. So you can see I started off pricing up a 3-month option, quarter of a year. And as we increase the time to expiry, you can see that the prices of calls and puts both increase. Now, the intuition here is exactly the same as the intuition we had with our volatility case. What I want is, I want to give the stock the maximum opportunity to move. And that can come from a high level of volatility. So we get big movements over a certain time period, either up or down, or it can come by just extending the time period. If I said to you, I want you to buy a 100 call from me, and I say to you that the stock is currently at 100 and it can move up or down 1 real per day. So that gives you an idea of its volatility. You know, tomorrow it could be 101 or 99. The day after it could be 102 at its highest, or 98 at its lowest, and so on. If I said to you, okay, there's 2 options. One is a 1-week option, so that's choice A, and the other one is a 1-year option. Now you can see, hopefully, and you get a kind of intuitive gut feel for this, the 1-year option will have the higher value because the stock can simply move further over that longer period than it could over just 5 business days. Over 5 business days, we can go up 5 or down 5, but that's the limit of it. Over a year, we can move up or down a much bigger amount. So when we think about option pricing, the effect of time and the effect of volatility actually do the same thing for us. They either increase or decrease the size of our possible positive payoffs. So if we buy an option, the higher the volatility of the stock, the more it will cost us. If we buy an option, the longer the expiry date, the more it will cost us. And here, hopefully, is a nice summary slide of the way that all of these price drivers work. So you can see I've got my 4 main price drivers there down the left-hand side. And if you look across, you can see for a certain movement, so for example, up in the stock, calls go up, puts go down. For the strike, we get the opposite direction if the strike moves up. And then for volatility and time, we get both calls and puts moving in the same direction for an increase in volatility or a decrease in time. So when we calculate the price of our option, we're going to have a certain value based upon where we are right now, as in where the stock is relative to the strike right now. And then there's going to be a certain amount of value, which you might call a what if value. What if the stock moves? Think about what could happen between now and expiry. And those two different values have different names. So when we're thinking about what's the minimum that the option could be worth today based on where the stock is trading right now, then that is what we call intrinsic value. And intrinsic value essentially says, if exercised today, what's the payoff? And remember, these are American style options that you'll be trading, so you can exercise them at any second of any day. If I exercise today, what's my payoff? So if I think of this graph down here, which is pricing up a 100 call, if we're sitting at 105, so the stock is trading at 105, then I know that the minimum that option can be worth is +5, because I could exercise it right now, buy the stock at 100, sell it simultaneously in the market at 105, and lock in a +5 gain. Everything extra that this option is worth is because there is still time left. There is still time left between now and expiry, and that is what we call time value. So that's this second bit here. Intrinsic value is easy and just a little bit boring. It's very easy to calculate. Mathematically, there's nothing really interesting going on here. It's just the difference between the current stock price and the strike price. Time value is hard mathematically and very interesting. So when we come on to session 5, when we look at pricing in a bit more detail, it will be the calculation of time value, which is the interesting bit. Oh, just before I move on, just worth noting on this slide, if you look at that graph, as we go either all the way over to the left-hand side or all the way over to the right-hand side, an interesting thing happens to our time value. So all the way over to the left-hand side, time value tends to 0. And this is because the probability of exercise, if I just put PX here, the probability of exercise is tending towards 0%. If I own a 100 call and the stock's trading way down at, let's say, 70, it's starting to look like that call will never finish in the money, and therefore I'm walking away. And if the option can never pay off, then it's going to be worth 0. So on a call option, as the stock goes down, there will reach a point at which it just cannot ever pay off. Its price will tend towards 0, and obviously its time value goes to 0. As we move up to the right-hand side, the probability of exercise tends to 100%. If the stock's trading at 150, it's now looking 100% probable that I will be exercising my 100 call, in which case it is now just a position in the stock. I can either exercise it right now, or I can wait until expiry and exercise it then, but I'm doing one or the other. So essentially I'm just long the stock. So again, the option premium at that point becomes relatively dull and fairly straightforward. It's just the value of owning the stock at 100 when the shares are trading at 150. So as we move off to either side of the price spectrum, the optionality, the thing that makes the option interesting, dies away, and the option either becomes 0% chance of being exercised, so it's just dead, or it becomes 100% chance of being exercised, in which case it's just a position in the stock itself. And the really interesting bit is when we're around the strike itself, when we're moving around the strike itself. That's the point of maximum uncertainty, and that's also where our time value is at its greatest. As I say, more deeper chat on this in session 4 and 5. For now, we're just developing the intuition around these things. Okay, so if we have prices moving up and down, it's worth us having a think about, can we calculate the magnitude of our price changes, and consequently, how much our profit and loss changes by as each of these price drivers move. So once we've traded an option, there are only 3 things that can change, because of course the strike is now fixed. So once we've traded, only the stock moving up and down, the volatility changing, and the time to expiry changing, only those 3 things can affect the price of our option. And of course, we can't do anything about time moving on. So today will become tomorrow, tomorrow will become the next day, and so on. And so there will be a certain progression of my option price through time. So what we do to measure these, to measure our sensitivity to these price drivers, is we calculate what we call risk metrics. And a risk metric will tell me, how does the price of my contract change if we get a 1 unit movement in the price driver? So if we think about a 1 real movement in a stock price, what does the option price become if we move up or if we move down? And this risk we call delta. Now, what you can see is that collectively, these risks are known as the Greeks. So if you hear people talking about option Greeks, they're talking about the risk metrics to all of these price drivers. Delta is a Greek letter, and it's part of why this set is called the Greeks. Theta is also a Greek letter, and theta is what we use to describe the effect of the passage of time. So as today becomes tomorrow, and there is now 1 less day in our option price, we lose a certain amount of money from that premium, and that is called theta. But another name for theta is time decay. So you may well hear this being described as time decay rather than the Greek letter theta. And then the final thing is a sensitivity to volatility. When I'm putting this number, and we had a look at a 20% number in the previous slides, but when I'm putting this number into my option pricer, if that number moves up or down and the premium changes, my sensitivity to movements in that number is called vega. Now, interestingly, vega is not a Greek letter. It's just something that the market made up, but it is still part of the family of risk metrics that we generally call the Greeks. So there are 3 main risk metrics there. If you were to dig a bit deeper into options and maybe buy yourself a textbook on options to read after this series of sessions, you would see that there are more Greeks than this. We can talk about gamma. You might hear something called vol gamma and vanna. You might hear rho and phi being used. They're all for different sensitivities. These are the simple ones, and we're going to cover these in this series of sessions. But if you do get a bit more deeper into options, you will come across other risks for describing slightly more subtle ways that the option price can change. This is how it might appear on your screen. So if you looked at the trading screen for the single stock options on the Saudi Stock Exchange, then it's going to give you a series of strikes. It's going to give you call and put prices for both strikes. And then what it's probably also going to give you is the Greeks. And we've got delta, vega, and theta here. Now, I've just come up with a hypothetical option price chain here. I've just used my option pricing model to generate me some prices and some risks. But what you can see is if we look at delta, for example, if we concentrate on 100 calls, you can see that the 100 call has a delta of 0.52, and the 100 put has a delta of negative 0.48. And equally, they have vegas and they have thetas. So we're going to deal with these now individually and see what they mean, how they tell us how the option price will be changing. So just zooming in on the 100 call, having a look at all of its details, you can see that at the moment, the price is trading at 3.99, so 3.99 real per share. Its delta, 0.52, is telling me that for a 1 real movement in the underlying share, so if this is Aramco, and let's say Aramco was trading around 35 Rial. If Aramco moved up or down to 36 or 34, the delta would tell me how much the premium of that option changes in both cases. And if we move up to 36, it would say that my option price would go up by 0.52. And if we go down, it would say that it would go down by 0.52. We remember that's the behavior of call prices. As the stock goes up, our call price goes up. Delta tells us by how much. So what we can do is if we did think, or rather, if we're trying to model what will happen to our option price if we get a movement up to 36, then what will happen is our original price of 399 will move up by 0.52. So our new price, if I just write this up at the top, new price will be 3.99 plus 0.52, which is 4.51. So our new 100 call price in the world where the stock's gone up by 1 is 4.51 per share. Okay, so understanding what my delta is tells me that if the underlying stock moves by 1 unit, the price will change by the delta amount. Vega and theta tell me the same, but for 1 unit in their price driver. So Vega tells me that for every 1% movement in the volatility input to my pricing model, my option is going to go up or down by 0.2. And theta will tell me that for every day that passes, and normally 1 unit of time in the world of options is 1 day, for every day that passes, my option value in this case will decrease by 0.02. So if 10 days passed and nothing else changed, my option would go down by 0.2. So if we have 10 days, we get a change of negative 0.2, which is 10 times my theta. The new price, therefore, would be 3.89 rather than 3.99 if nothing else had changed. Okay, question for you. Just having a think now about delta. I just want you to try in your own heads to think about what's the intuition as to why put options have a negative delta. What is that telling me? That the delta on the call option we just looked at told me how much the option price increased if I had an increase in the stock. So if I had a positive delta and a positive change in the stock price, I got a positive movement in my option price, as in it went up. Can you just have a think, just again for 30 seconds, what's the intuition around the delta of a put option being negative? So I'll come back in 30 seconds time after you've had some thoughts. Okay, good. We've had a couple of answers on the chat which look broadly correct to me. Let's just do it as rigorously as we can. What delta is telling me is, and if I just write out an equation at the top, it's telling me the change in the price. So actually, I won't use delta P because that reuses the delta symbol. Let's put change in price, and it's telling me that per change in stock. So if I can observe how much my price changes for a 1 unit change in the stock, that gives me my delta. If I know what my delta is, and I know what my stock price is, then to get the change in my option price, I just multiply those things together. So if we just quickly rearrange this equation, I can say that the change in my price is equal to the delta of my option multiplied by the change in the stock. So for a call option, we had a positive delta, and when we put in a positive change in the stock, we got a positive movement in the price, as in call prices go up when the stock moves up. Now we've got put options, which have a negative delta. But that means that if we have a negative movement in the stock, then those two negatives multiplied together will give me a positive movement in price. So the intuition here is put prices go up when the stock goes down, and that's what the delta is telling me. So what the delta is really doing is it's saying, if you give me the price function for an option, so here, this green line here, this is the price of a 3-month 100 call as the stock moves up or down. And you can generate this in an option pricer, and we'll do this certainly in session 5. You can generate this graph by just changing the stock as your input and just observing what happens to the price of the call. What you're really doing when you're saying, what's my sensitivity to movements in the stock, is you're saying, what's the gradient of my price line? How much do we change in the y-axis for a unit movement in the x-axis? And so because a call price goes up with the stock, it has a positive gradient, and therefore its delta is also positive. And a put has a negative gradient, and therefore a negative delta. Now, sometimes when you see options trading in the market, the minus sign on a put may get dropped, and that's simply because everybody knows it's there, so we don't need to write it down, essentially, or we don't need to say it out loud. So somebody might say, I'm trading a put option with a delta of 0.4. What they mean is, mathematically, it means negative 0.4, but we're just saying 0.4 out loud because we hope that the person on the other side of our conversation understands that puts have a negative delta. Okay, so a couple of things to understand here. The delta of the put is negative. Also, and you can observe this just by looking at the green and the red lines, delta does not stay constant. In fact, delta varies between 0 and 1 for a call option. So when we're right down here on the left-hand side, delta is 0, and that's because the option's dead. So moving up or down in the stock by a small amount doesn't have any effect on my price because my price is 0 regardless. And then up on the right-hand side, delta will be 1 because the exercise probability is now 100%. And so this option is just a position long the stock. And of course, if I'm long the stock, my P&L changes by 1 real for every 1 real movement up and down in the price. So I move 1 for 1. So a call option can vary between a delta of 0 and +1. And for the same logic, a put option can vary between a value of 0 and -1. So put options are between 0 and -1. Call options are between 0 and +1. And for at-the-money options, and this might come in handy when you're trading these things, for at-the-money options, so a 100 call when the stock is trading at 100, the delta is approximately 0.5. By the way, you might hear this being called a 50 delta, because as well as representing delta as a decimal, 0.5, we sometimes use a percentage measure as well. So 50% is the same as 0.5. Then we drop the percent sign and we just say 50 delta. So if you hear people talking about a 40 delta put or a 10 delta call, what they mean is a 0.4 delta put and a 0.1 delta call. Okay, so zooming in on the 95 put here, so you can see I put a box around the 95 put. You can see that it's currently trading at a premium of 1.89 real per share, and it has a delta of negative 0.29. Your question is, if you buy 50 contracts of this put, and then the stock moves down by 3.5 rial, what is your P&L? Each contract, if you remember, is 100 shares. So you're going to have a position which is equal to 5,000 shares, the right to sell 5,000 shares at a price of 95, because that's your strike. As the stock moves down by 3.5 rial, what's your overall cash P&L in rial? So I'm going to give you another 30 seconds to have a think about this. If you can't come up with a number, don't worry. Come up with the methodology in your head. Just think, I think this is what I would do. And then you can compare that methodology to what I tell you in about 30 seconds. If you can come up with a number, of course, that's great. Okay, so to do this, I'm just going to switch us to Excel, and we'll have a look through the numbers. So I've got my original price of 1.89. I've got my delta of negative 0.29, and I've got a stock move equals minus 3.5 rial. So one easy way that I can think about how this price changes is, or how my P&L changes, is I could first think, how does the price change? So let's first think, how does the price of the option change? So we'll start with its old price. Its old price, of course, is 1.89. And then I'm going to get a price change. And the price change is going to be equal to delta multiplied by the stock move. So my price change here, if I multiply the stock move, which of course is a negative number because the stock's gone down, and I multiply that by the negative delta of the put, I'm going to get a positive movement in its price. So the put's price will move up by 1.015 rial per share. So the new price will be the sum of the old price and its change. So you can see that I've got a new price of 2.905. If I just shrink this down a little bit, I can now say, okay, what does the value of my position change by? So again, let's start with the old value of my position. The old value of my position, given that I've bought this put option, is equal to its original price multiplied by the contract size of 100, multiplied by the position that I've got, long 50. So originally, when I bought this, I would have paid 9,450 rial for it. Now I can have a look at the new value, and the new value is just going to be equal to the new price multiplied by the 100 size multiplied by my 50 contracts. So the new value is 14,525. And therefore my P&L is going to be equal to the change in those. So my P&L, 5,075 rial. So you can see that I can approach it this way. I can just say, well, how does the price of the option itself change per share? And then my position of 50 contracts in 100 shares per contract has a certain cash change that's been driven by that price movement. So movement of just over 1 real in the price of the option changes my P&L by just over 5,000 real, because I have an effective position size of 5,000 shares. The other way that you could work it out is you could say, can I calculate my position delta? As in, is there a number that I could say that the number of real that I will make or lose as the stock price goes up or down by 1 unit? And I can. So my position delta, and we'll see this on a slide in a minute, is equal to the option delta multiplied by the contract size, which is 100, multiplied by my position in contracts. So that makes my position delta here. Oops. If I actually now calculate this as a number, my position delta is equal to the delta of the option, negative 0.29, multiplied by the contract size, multiplied by our 50 contracts. So there you can see I got a position delta of 1,450, and this is a short position because I will make money as we get a negative movement in the stock, and I will lose money as we get a positive movement. So my P&L now can just more simply be calculated by taking my position delta and multiplying it by the move I saw of the 3.5 real negative. And so again, we get this 5,075 real position, P&L. So it doesn't matter whether you think about your overall risk position in real, or whether you think about the change in the underlying option price and then just scale it up to your position in that option, you're always going to get the same answer regardless of the route. Okay, so that's using delta, and there's our descriptor down the bottom. Note that I've used an approximately equal sign here because my delta is not constant. So the effect of the movement in the stock itself will change the delta of my option. And therefore, when I assume the stock moves by a fixed amount, a constant amount, this will only ever be an approximate number. But it's a good way of generating an approximate answer so that we're not surprised when we calculate the real answer later on. So what's delta telling us? Actually, delta is one of the most interesting risks of an option because it tells us a few things. Firstly, it tells us how much does the price change by for a movement in the stock, and then hence, how does our P&L change? The second thing is it gives us what we call the hedge ratio. It tells us what our effective position is in the stock at any point in time. So for example, we buy 50 contracts of a call option with a delta of 0.3. Our effective position in the stock is that of a 30% size, a 0.3 size in the underlying stock. So 50 contracts would normally take me long or short 5,000 shares. The 0.3 scaling tells me that actually I'm long 1,500 shares here. So what it says is if I buy this call option in 50 contracts, it's giving me a movement in terms of its price or a change in my P&L equivalent to me being long 1,500 shares. And the reason we call this the hedge ratio is if I wanted to hedge my position now, as in reduce my risk down to 0, then I would sell 1,500 real shares against my virtual long position that's coming through the call option. So when people hedge their option risks, they're using their delta to take an opposing position in the stock, which offsets the effective position that the call option or the put option is giving them. And another interesting use of delta is it gives us an approximation to the probability of exercising our option. So if I said to you we're trading a delta with a call option with a delta of 0.3 or 30%, that means that approximately this option has a 30% chance of being exercised. So you can use that now as you're making your trading decisions. You can look at those option deltas and you can think, do I agree with that probability estimate? Do I think if I'm looking at a 30 delta call on Aramco, do I really think that the probability of finishing above that strike is 30%? Or do I think it's higher than that? Or do I think it's lower than that? And so you can then layer on your real world probability on top of this mathematical outcome and decide if you want to buy that option or not. And all of these risks are additive. So the delta will tell us how our price and P&L changes for a movement in the stock. The vega tells us how the price and P&L changes for a movement in volatility, and then the theta tells us the same for the passage of time. So if we get more than one price driver moving, we just add the effects of both together. So here, we're imagining that the stock moves down. So we're still got that position where we're long 50 contracts of the 95 put. This time we've got two price drivers moving. We've got the stock moving down by 3.5 real, but we've got volatility going down by 2%. So if we have a look at our Greeks, the negative delta tells us we want the stock to move down. A negative movement in the stock multiplied by a negative delta will give us a positive change in the price. We're long the option, so we want its price to go up. However, our positive vega tells us that if volatility in the market moves down, and by that I mean this number that people are putting into their option pricer, if that moves down from, let's say, 20% to 18%, then the price of our option will decrease because the price of all options decreases in a world which is now expected to be less volatile than it was previously. So you can see what we can do is we can calculate our combined effect. This is the 5,075 real that we calculated on the previous slide. That's the effect due to delta. So that's telling me that the stock movement down of 3.5 real has increased my P&L by 5,075. But if I now look at my positive vega multiplied by a negative movement in the vol, multiplied by 100, multiplied by my 50 contracts, you can see that my P&L due to vega is a loss of 1,700 real. And so my combined profit is a now reduced 3,375 real because I'm getting offsetting signs on my two price drivers. So when you're trading options, understanding how your P&L changes is more interesting and more complex than if you're trading just basic cash stocks or futures contracts. If you're trading cash stocks or futures contracts, you have one single price driver and one single risk metric, and that is, does the stock go up or down? Does the price of the futures contract go up or down? With options, you've got three instead of one. You're thinking, what's going to happen to the stock? And also, what's going to happen to the volatility parameter that prices these options in the first place? And then what's going to happen to the passage of time? And sometimes all of these things go your favor, and sometimes they all go against you, and sometimes one might go in your favor, the other two go against you, and so on. So it's a complex task, understanding and managing an option position, but it's a rewarding task as well. It gives you more to think about. There are more moving parts. It is just more complex as a trading product than the underlying products that you're probably a little bit more familiar with. Okay, so I told you that we could calculate our position risk, and I did it in Excel, and this is how we do it in terms of the formula on the slide. If you take any of your risk metrics for the option, so this is per share risk metrics that the pricing screen is just giving you. Then if you multiply them by the contract size, which for the the options you're going to be trading on the Saudi exchange is 100 shares, and then you multiply it by your position, whatever that is, X, then you will get your position risk for a particular risk metric. So just imagining another trade, we go short 200 contracts of a 100 put with a delta of negative 0.48. Our position delta is going to be the puts delta multiplied by the 100 contract size multiplied, and we have to be careful here, by our negative position in it. So we've gone short these contracts rather than long. And you can see we've got two minuses here cancelling out and creating a plus. So what this means is that for every +1 real movement in the stock, we get a plus 9,600 real of profit. And hopefully that is intuitively correct. We've sold a put option here in 200 contracts. When I sell a put option, I want it to finish out of the money. That's my best result. So its price will move in my favor if the stock moves up, and therefore it becomes less and less likely to pay off. So a negative position in the put combined with a negative delta gives me a positive delta to my risk position. I want the stock to move up. And again, treating delta like a hedge ratio, what this short put position is telling us is I'm effectively long 9,600 shares in whatever this underlying stock is. So I want the share price to move up. And then because everything's additive, if I calculate my position risk in each of these three main parameters, then I can work out my P&L by just adding up all of the effects. So you can see that my P&L due to delta, and then my P&L due to Vega, and then I've got my P&L due to theta. Just a quick note of caution though down at the bottom, none of these risks are constant as the price driver changes. So this equation will always just be approximate. Of course, your real P&L is generated when you mark your options to market at whatever the market price is on the exchange. But this gives you an understanding as to how your P&L will move under certain scenarios. Okay, if I want to hedge my risk on an option, then I just need to try to move my position risk down to 0. I mean, that's the perfect hedge. If I can get the risk on my position to be 0 in all three dimensions here, my risk to the stock, my risk to volatility, and my risk to time, if I can get all of those down to 0, I can relax. I have no remaining risk position left. If I want to hedge my delta, I can do that with the underlying stock, because my delta will tell me what's my effective position in the stock, and therefore how much stock do I need to trade against my option to neutralize that position. This is the only risk parameter that I can hedge with the stock though, because all of these extra effects, and you can see I've included this gamma here, but this is a higher order risk that we may talk more about in session 5. All of these other risks are option specific. So they are something which is specific only to options, and therefore if I want to hedge them, I can only hedge them with other options. So the hedging method therefore is to calculate what my position risk is in Vega and theta, and then find another option or size up another option, which will give me an equal and opposite Vega and an equal and opposite theta, and then trade those new options. So those option-specific risks can only be hedged with other options. We've got a question here saying, are these Greek values moving intraday? Yes, they are. Yeah, I mean, in theory, the values are changing continuously. second by second, the changes are going to be very small. But day by day, yes, you could see a significant, if you get significant movements in the price drivers, then yes, you could see significant changes in your delta, your vega, and your theta. Yeah, and the other Greek letters that I mentioned about half an hour ago, they indicate the rate of change of some of these Greeks. So gamma, for example, since it's up there on the screen in front of us, tells us the rate of change of our delta. How quickly is the delta changing? If I have low gamma, my delta is fairly constant. And if I have high gamma, my delta is changing quite rapidly. Yeah. But for now, we're just sticking with the simple first order risks, and we might introduce some of the higher order, more mathematically complex risks in session 5. Okay, that's basically brought us to the end of the session. I know we had a slightly delayed start, so apologies again for that, but we're at 7:27-ish Saudi time. So if you do have any final questions, now's the time to pop them on the Zoom chat. Here is the now traditional exercise that I leave you with. So it's an extension of what we've just been doing. What I'm telling you is you've got a short position of 100 contracts in a 3-month put, and these are your risk parameters over here. You've got a delta, a vega, and a theta, and I want you to tell me what happens to your P&L if we get these moves. So over the next week, through which 7 days are going to pass, the stock price goes up by 2 and volatility comes down by 3%. So using all of these numbers, I want you to work out what your P&L is. Now, the important point here is you don't need to know what price of this option is today. Therefore, you don't need to know what the price of the option will be in the future. All your P&L is being driven by is the change in that option price. So it starts at a price of X, it moves to a price of Y. You're just sensitive to what that movement between X and Y is. So I wonder if you can have a work through that. So either use the materials that you get sent after the course to answer this question, or if you want to, you can take a quick photo of the screen or a screenshot of the screen now, and then have it. And we'll debrief this at the start of the next session next Wednesday. This is what we'll do next Wednesday in session 4 for those of you who are carrying on with us into part 2, and I hope that's the majority, if not all of you. So in session 4, we're going to talk in a bit more depth about this volatility thing. So far, I've just said if volatility in the market goes up or down. Hopefully you're sitting there thinking, but what does that mean? How would people decide if the volatility has gone up or down? That's the subject that we'll be talking about in session 4. So we'll talk about how we measure volatility, how we might talk about how volatile something's been in the past, what we call historical vol, and then this concept of implied volatility, the number we put in our pricer that reflects how volatile the stock will be in the future, and how we compare those two things, the past and the future. And then we're going to finish with a really interesting bit called the volatility smile and skew. And this is where option pricing, I think, again gets yet more interesting. We get some extra moving parts here. For those of you who know a little bit about options already, you might have heard of smile and skew. For those of you who don't, we'll introduce it nice and gently in session 4. The email address, as usual, if you want to get in touch, that's the email address to use. That has changed since the last session, so they've asked me to update you on the new email address to use. So please, any future inquiries, please use this new email address. And as I said at the start of the session, if you send through a nice, interesting, short question, then we'll look to answer those questions at the start of the next session. If you send through quite an interesting, maybe more long-winded question, we might take those kind of questions and use them as the basis for session 6, when we have that question and answer session where I look at some of the things you've posed, and maybe I can create my own hypothetical scenarios that we'll examine as well. Okay, good. So that's all we have for you today. Just have a quick look through. I don't think there are any unanswered questions in the chat, apart from someone has recommended or asked me to recommend a book on options. This is something I have to admit I get asked a lot. And there's no easy answer to this, to be honest, because what you might find with option books is a lot of them are either very basic or very complex. They're either at the complex end of the spectrum, they're just very mathematical. So they're a bit like a textbook that you might see in a degree level maths course. At the basic end of the spectrum, they're too basic. And so there's very few books are written for that middle ground. When I was a trader, I quite liked the writing of Nassim Taleb. I'll just quickly put his name on the chat. Nassim Taleb is a former options trader. He's written some books. If you have a look at some of the books that he's written on options, there's some good ones. There's some good ones in there. There was one called Dynamic Hedging, which I particularly liked when I was an options trader, so that might be worth a look. Good. If there's no further questions, thank you for attending. Enjoy the rest of your evening. We'll see you again if you're going through to part 2. We'll see you again next Wednesday for a talk on volatility. But I'm happy to stay around now if anyone's got any quick questions on Zoom. Failing that, yeah, have a good night, and I'll see you in a week.